Think about this for a second. Today, when you buy a home in America, you walk into a bank, you sign a stack of papers, and you agree to pay back that loan over the next 30 years. 30 years. That's an entire generation. You could raise a child from birth to adulthood in the time it takes to pay off a single house. And we don't even question it. We treat the 30-year fixed-rate mortgage like it's some kind of natural law, like gravity or compound interest. Something that's always existed, something baked into the fabric of American life. But here's the thing, it hasn't always existed. In fact, the 30-year mortgage as we know it didn't appear until 1934. And before that year, buying a home in America was a completely different experience. It was harder, riskier, and far more exclusive. For most of American history, home ownership wasn't a right. It wasn't even a reasonable aspiration for the average working person. It was a privilege, reserved almost exclusively for the wealthy. So the question becomes, if the 30-year mortgage didn't exist for most of this country's history, how did Americans actually buy homes? What did that process look like? And what had to go so catastrophically wrong that the federal government had to step in and completely reinvent how an entire nation finances shelter? Well, to answer that, we need to go back, way back, to a time before banks were in the business of handing out home loans at all. Because the story of how America built its housing system is really a story about power, about who gets to own land, about who gets locked out, and about a series of financial innovations that literally reshaped the physical landscape of the country. Let's start at the very beginning. In the earliest days of the American Republic, land ownership wasn't really about banks or mortgages or monthly payments. It was about the federal government and what it chose to do with the vast, almost incomprehensible amount of land it controlled. After the Revolutionary War, the new United States government found itself sitting on millions upon millions of acres of territory, stretching westward into regions that most Americans had never even seen. And the question of how to distribute that land became one of the most contentious political debates of the era. Now, the Land Ordinance of 1785 was the first major attempt at creating a standardized system. It divided public land into neat 6-square-mile townships, and those townships were then subdivided into 36 sections, each one measuring 640 acres. This was revolutionary in terms of surveying and organization, but there was one enormous problem. The minimum parcel size was massive, and the prices were set high enough that ordinary settlers, the farmers and laborers who were actually willing to move west, couldn't afford to participate. By 1800, the federal government had reduced the minimum lot size to 320 acres and allowed buyers to pay in 4 installments. But even so, the price remained fixed at $1.25 per acre, and you needed to buy an enormous tract. For a working family scraping together wages in the early republic, that might as well have been $1 million. This wasn't a system designed for the common man. It was a system designed for land speculators and wealthy investors, people who had the capital to buy large parcels and then flip them for profit to smaller buyers. And so for decades, the primary way most ordinary Americans came to own land wasn't through a bank, wasn't through a mortgage. It was through sheer physical labor and the willingness to move into the wilderness and carve a life out of nothing. Many families simply squatted on unclaimed land, built a cabin, cleared some trees, planted crops, and hoped that when the government eventually got around to surveying the area, they'd have some kind of claim. This was rough, informal, and legally precarious, but for millions of early Americans, it was the only path to ownership. Then, in 1862, everything changed. In the middle of the Civil War, with Southern legislators who had blocked such measures now absent from Congress, President Abraham Lincoln signed the Homestead Act. And this was, without exaggeration, one of the most significant pieces of legislation in the history of the United States. The deal was stunningly simple. Any adult citizen, or anyone who had declared their intent to become a citizen, could claim up to 160 acres of public land. All they had to do was live on it, improve it, cultivate it, and stick it out for 5 years. After that, the land was theirs, free and clear, for a filing fee of about $10. The numbers are staggering. Between 1862 and 1976, the Homestead Act distributed more than 270 million acres across 30 states. That is 10% of the total land area of the entire United States transferred from public ownership to private hands. Over 2.3 million claims were filed. More than 900,000 land patents were granted. Entire regions of the Great Plains and the American West were transformed from empty prairie to patchworks of family farms and small towns. And this is how a huge chunk of the American heartland was settled. Not through sophisticated financial instruments, but through grit, endurance, and the willingness to plow frozen ground. But here's the important caveat. The Homestead Act worked for rural, agricultural land. It did not solve the question of how ordinary people could buy homes in the rapidly growing cities of the East Coast and the Midwest. As America industrialized throughout the late 1800s, millions of people poured into cities like New York, Boston, Philadelphia, Cleveland, and Chicago looking for factory work. These people weren't looking for 160 acres of prairie. They needed a house, a small plot, maybe a row home on a crowded street. And for them, the question of how to pay for a home was a completely different problem. Now, in the cities, if you wanted to buy property, you essentially had two options. The first was the simplest and the most exclusive. You paid in cash, full price, upfront, no financing, no debt. And obviously, the number of people who could do this was vanishingly small. In the early 1900s, home buyers were often expected to put down 50% of the property's value, just as a down payment. 50%? Think about what that means. If a modest house cost $4,000, and this was a reasonable price for a working-class home in many cities at the turn of the century, you needed $2,000 in savings before you could even begin the conversation about buying it. To put that in perspective, the average annual wage for an American worker in 1900 was somewhere around $400 to $500. So accumulating a $2,000 down payment meant saving every single penny you earned for 4 or 5 years, spending absolutely nothing. No food, no rent, no clothes, nothing. It was mathematically impossible for most families. And the second option? Well, that was what we might loosely call a mortgage, but it bore almost no resemblance to the mortgages we know today. In the late 1800s and early 1900s, a typical home loan worked like this. You'd go to a savings and loan association, a local bank, or maybe a life insurance company. If you were lucky enough to qualify, you'd get a loan for maybe 50 to 60% of the home's value, meaning you still needed that enormous down payment. The loan itself would have a term of just 3 to 5 years, sometimes as long as 10, but rarely more. And during those few short years, you didn't pay down any of the principal at all. You made interest-only payments month after month, paying the bank for the privilege of borrowing their money, but never actually reducing what you owed. And then, at the end of that 3 to 5 year window, the entire remaining principal came due in one massive lump sum. This was called a balloon payment, and the word balloon is almost darkly comic when you think about what it meant for real families. You'd spend years making your interest payments on time, keeping your home clean, raising your kids, building a life in that house. And then one day the bank would come knocking and say, "Right, you now owe us the entire original amount of the loan, and we'd like it all at once, please." Now some people could handle this. If you'd been saving diligently, or if property values had risen and you could sell, or if you could find another lender willing to refinance, you might be okay. But for a huge number of borrowers, the balloon payment was a trapdoor. When it came due, they simply didn't have the money. They couldn't refinance, and they lost their homes. The default rate on these kinds of loans was enormous, and it created a constant churn of families being pushed in and out of home ownership. You weren't really buying a home in any stable sense. You were renting the idea of ownership, always with that ticking clock counting down to the day the full bill came due. Now, there was one institution that tried to make home ownership more accessible for ordinary people, and it emerged long before the federal government got involved. These were called building and loan associations. The first one in America, the Oxford-Providence Building Association, was founded in 1831 in Frankfort, Pennsylvania, and the concept was beautifully simple. A group of working people in a community would pool their savings together. Each member would buy shares in the association, and as the pool of money grew, members could take turns borrowing from it to buy or build a home. Once one member paid off their loan, the next person in line would get theirs. The genius of the building and loan model was that it sidestepped the traditional banking system entirely. National banks at the time weren't even allowed to make mortgage loans, and state-chartered banks often required those crushing 60% down payments. The building and loan associations operated on mutual self-help, a community of neighbors literally financing each other's homes. Members weren't just depositors, they were shareholders, and they had a voice in how the money was managed. And the terms were better too. While bank mortgages in the 19th century were short-term 3 to 5 year interest-only affairs, the building and loan associations offered something more generous. Their loans typically stretched to 8 or even 12 years. They included amortization, meaning borrowers were actually paying down their principal with each payment. This was a meaningful difference. It meant that when you made your monthly contribution, you were building real equity and actually getting closer to owning your home free and clear, rather than just treading water until the balloon came due. By the 1880s, these institutions had spread across the country like wildfire. Thousands of local building and loan associations were operating in virtually every city and town. They were small, deeply rooted in their communities, and enormously popular. By 1930, building and loan associations had 12.3 million members and close to $9 billion in assets. They held roughly a third of all intermediated home mortgage debt in the entire country. If you were a working-class family in America at the turn of the century and you managed to buy a home, there's a good chance a building and loan made it possible. Now, if you're thinking this sounds familiar, you're not wrong. The most famous building and loan in American culture is a fictional one, the Bailey Brothers Building and Loan from the 1946 film It's a Wonderful Life. And the reason that movie resonates so deeply is that it captured something real. Those institutions were the backbone of working-class home ownership in America for a century. They were what stood between ordinary families and the cold indifference of the banking establishment. But even with the building and loans filling the gap, home ownership remained stubbornly limited. By 1900, less than half of American households owned their homes. The home ownership rate hovered around 46.5%, and it actually declined slowly from 1900 to 1920. This wasn't just about access to credit, though that was a huge part of it. It was also about the way American cities were growing. Urbanization was happening at a ferocious pace, and the flood of immigrants and rural migrants into industrial cities drove up housing costs faster than wages could keep up. Tenement apartments, boarding houses, and cramped rental quarters were the norm for millions. The idea of a family owning their own home was for many a distant fantasy. Then came the 1920s, and the Roaring Twenties didn't just roar on Wall Street, the housing market exploded alongside it. A booming economy, rising wages, easy credit, and a contagious national optimism combined to create a housing bubble that in hindsight had disaster written all over it. Between 1920 and 1930, total residential mortgage debt in America tripled. The Savings and Loan Associations alone mortgaged 4.35 million properties, totaling more than $15 billion in loans. Home ownership rates actually climbed during the 20s, reaching a peak of around 47.8% by 1930. More Americans were buying homes than ever before, but the way we're doing it was precarious. Balloon mortgages were still the norm, short terms, interest-only payments, that looming lump sum at the end. And something dangerous was happening with the debt-to-equity ratios. People were borrowing much larger amounts relative to the purchase prices and to their own incomes and savings. A crazy quilt, as one historian described it, of land contracts, second and third mortgages, high interest rates, short terms, balloon payments, and various other high-risk practices. It was a house of cards, and everyone was pretending the wind would never blow. And then, of course, the wind blew. The stock market crashed in October of 1929, and what followed was the most devastating economic collapse in American history. The Great Depression didn't just destroy the financial markets, it reached into every corner of American life, and nowhere was its devastation more acutely felt than in the housing market. Here's what happened. Banks started failing, not one or two, thousands of them. By 1933, more than 9,000 banks had closed their doors, and when the banks went down, they took the credit system with them. Suddenly, there was no money to lend. Businesses couldn't get financing, workers lost their jobs, and families who had been making those interest-only payments on their balloon mortgages found themselves unable to keep up. Wages fell, unemployment soared past 25%, and one by one, millions of homeowners began to default. The numbers are almost too grim to comprehend. By the spring of 1933, nearly 1,000 families a day were losing their homes to foreclosure. 1,000 a day. By 1932, roughly 250,000 households had already been foreclosed on. A year later, half of all mortgages in the United States were in default. The entire system was collapsing in on itself. Banks that held these defaulted mortgages were themselves going under, which meant even fewer loans available, which meant more defaults, which meant more bank failures. It was a vicious self-reinforcing spiral, and it threatened to destroy the concept of home ownership in America entirely. And the building and loan associations, those community institutions that had been the lifeline for working families, they were getting hammered too. More than a third of the roughly 16,000 such institutions in the country were dragged into the whirlpool of the Depression, and the commercial banks they relied on for supplemental funding went under. The building and loans lost their credit lines. Withdrawals accelerated, members panicked, doors closed. The home ownership rate plummeted. It fell from that 1930 peak of around 47.8% to an all-time low of 43.6% by 1940. The American dream was drowning, and nobody seemed to know how to throw it a lifeline. And so the federal government did something that would have been unthinkable just a decade earlier. It intervened massively and permanently in the American housing market. And in doing so, it created the entire system of home finance that we live with today. The first major move came under President Herbert Hoover, believe it or not, who is often remembered as doing nothing during the Depression, but actually did attempt some structural reforms. In 1932, he signed the Federal Home Loan Bank Act, which established a network of 11 geographically scattered federal home loan banks. These were modeled after the Federal Reserve System, but designed specifically for the mortgage market. Their purpose was to serve as a lender of last resort for savings and loan institutions, providing them with liquidity so they could keep making home loans even during a crisis. It was an important structural change, but it wasn't enough to stem the bleeding. The real transformation began in 1933, when Franklin Delano Roosevelt took office and launched the New Deal. On April 13th of that year, Roosevelt went before Congress and asked for legislation to protect small homeowners homeowners from foreclosure. Lawmakers responded with startling speed. On June 13, 1933, they created the Homeowners Loan Corporation, the HOLC. Now, the HOLC didn't lend money directly to homeowners. What it did was even more radical. It purchased mortgages that were in default or foreclosure from banks and other lenders. In exchange, the lenders received government bonds. The HOLC then refinanced those troubled loans on terms that were dramatically better for the borrowers, converting short-term balloon mortgages into 15-year fully amortized loans with interest rates around 4.5%. This meant that for the first time, struggling homeowners could make monthly payments that actually covered both interest and principal, spreading the cost over a long enough period that the payments were manageable. By the time the HOLC stopped lending in June of 1936, it had purchased and refinanced over 1 million mortgages, totaling more than $3 billion. It had quite literally saved hundreds of thousands of American families from losing their homes. It demonstrated something crucial, that long-term fully amortizing mortgages actually worked. They were safer for borrowers and they were more stable for lenders, and they kept the broader economy from spiraling further into collapse. But the HOLC was designed as a temporary rescue mission. The government knew it needed a permanent solution, something that would prevent this kind of catastrophe from ever happening again, and fundamentally reshape how Americans finance their homes. And that's where we arrive at 1934, the year that changed everything. On June 27, 1934, Congress passed the National Housing Act and with it created the Federal Housing Administration, the FHA. And this is the moment when the modern American mortgage was born. Now, to understand why the FHA was so revolutionary, you have to understand the problem it was designed to solve. After the Depression, lenders had become utterly paralyzed by fear. They'd lost enormous sums on defaulted mortgages, and the surviving banks were terrified to lend again. Credit had virtually dried up. At this point, only about 1 in 10 Americans could afford to own a home under the existing terms. The market was frozen. The FHA's solution was elegant in its simplicity. The federal government would insure mortgages against default. That meant if a borrower stopped paying, the government would cover the lender's losses. This insurance dramatically reduced the risk for banks, which in turn gave them the confidence to start lending again. But the FHA didn't just insure the same old balloon mortgages, it completely rewrote the rules. FHA insured loans had to be long-term, initially 15 to 20 years, and eventually extending to 25 and then 30 years. They had to be fully amortizing, meaning every payment reduced the principal, and you owned the home outright when the last check was written. They required down payments of only 10 to 20%, a dramatic reduction from the 50 to 60% that had been standard. And they carried fixed interest rates, so borrowers knew exactly what they'd pay every single month for the life of the loan. This was a complete overhaul of the American housing finance system. Before the FHA, a mortgage was a short-term gamble. After the FHA, it became a stable, predictable, long-term commitment. Before the FHA, buying a home required enormous wealth or dangerous risk. After the FHA, it became something that a middle-class family with a steady income could realistically achieve. Now, it's important to note that the 30-year term specifically didn't appear overnight. The FHA initially offered 15 and 20-year loans, and the agency kept gradually extending the maximum term. Congress didn't formally authorize 30-year mortgages for new construction until 1948, and for existing homes until 1954. And even then, the concept was slow to take root. Average loan terms in the late 1940s and early 1950s were still around 21 years. The 30-year term didn't truly become the dominant standard until the 1960s, but the seed was planted in 1934, and every subsequent extension grew from that original FHA framework. But the FHA alone wasn't enough to make the modern mortgage system work. There was still a fundamental structural problem. When a bank makes a 30-year loan, that money is tied up for 3 decades. The bank can't use those funds to make new loans. If every bank's capital was locked into long-term mortgages, the supply of new lending would eventually dry up again. And so, in 1938, the federal government created the Federal National Mortgage Association, which everyone came to know by its nickname, Fannie Mae. Fannie Mae's role was to create something that had never existed before, a secondary mortgage market. Here's how it worked. Banks would originate mortgages, lending money to individual home buyers. Then, Fannie Mae would buy those mortgages from the banks, giving the banks fresh capital to make new loans. Fannie Mae would either hold the mortgages as investments or package them together and sell them to investors. This created a continuous cycle, money flowing from investors to Fannie Mae, to banks, to home buyers, and it ensured that the supply of mortgage lending would never dry up the way it had during the Depression. This was an entirely new invention. Before Fannie Mae, a local savings and loan in Ohio could only make as many loans as its depositors' savings would support. After Fannie Mae, the same institution could sell its loans on the secondary market and immediately have fresh capital to lend again. The entire country's savings could now flow into housing through a national network of mortgage finance. It was in many ways the financial equivalent of building the interstate highway system, a massive infrastructure project that connected local markets into a single nationwide network. And then came the event that supercharged the entire system, World War II. When the war ended in 1945, millions of young men came flooding back to American shores. They'd spent years fighting overseas, and they came home with a desperate desire for normalcy, for stability, for a home of their own. But the housing stock was woefully inadequate. Construction had essentially stopped during the war years, and there weren't nearly enough homes to go around. The federal government's answer was the Servicemen's Readjustment Act of 1944. Better known as the GI Bill. And among its many provisions, the GI Bill offered something extraordinary: home loan guarantees for veterans with virtually no down payment and low interest rates. Think about what this meant. A returning soldier, a man who might have grown up in poverty, who might have nothing but the clothes on his back, could walk into a bank and, backed by the full faith and credit of the United States government, get a mortgage to buy a house without putting a single dollar down. This was unprecedented. It was radical, and it transformed the country. The numbers are breathtaking. By 1955, 4.3 million home loans had been granted through the GI Bill program, with a total face value of $33 billion. Veterans were responsible for purchasing 20% of all new homes built after the war. The demand was so enormous that it gave rise to entirely new forms of housing development. Builders like William Levitt seized the moment. In 1946, Levitt and Sons purchased 4,000 acres of potato farmland on Long Island, New York, and began mass-producing homes at an industrial scale. Every house had the same floor plan. Assembly line techniques were applied to home construction. Cape Cod-style homes rolled off the production line like automobiles, and they sold for about $7,000 apiece, or roughly $29 a month on a government-backed mortgage. Levittown became the prototype for an entirely new way of living, the American suburb, and it was replicated across the country from coast to coast in a frenzy of development that reshaped the physical geography of the nation. Where there had been farmland and forest, there were now neat rows of single-family homes, each with a yard, a driveway, and a white picket fence. The suburban dream, the image that still dominates our collective imagination when we think of American middle-class life, was essentially created in this moment, built on the foundation of the 30-year mortgage and government-backed lending. The home ownership rate tells the story in stark, unmistakable terms. In 1940, at the tail end of the Depression, only 43.6% of American households owned their homes. By 1950, that number had jumped to 55%. By 1960, it had reached 61.9%. In just 20 years, America went from a nation of renters to a nation of homeowners. The rate of increase was unprecedented, and it hasn't been matched since. The combination of FHA insurance, VA-backed GI Bill loans, Fannie Mae's secondary market, the 30-year fixed-rate mortgage, favorable tax laws that allowed homeowners to deduct mortgage interest, and a booming post-war economy created a perfect storm of homeownership expansion. But the story isn't all white picket fences and backyard barbecues. There's a darker chapter that needs to be told, because the system that opened the door to homeownership for millions of white Americans simultaneously slammed it shut for black Americans and other minorities. It goes back to the HOLC, and the same agency that rescued 1 million mortgages during the Depression. In the late 1930s, the HOLC created a set of residential security maps for major American cities. These maps divided neighborhoods into 4 categories, graded from most desirable to most hazardous, and color-coded accordingly. The safest neighborhoods were shaded green, the most risky were shaded red, and the criteria for assigning those colors weren't purely financial. They were deeply systematically racial. Neighborhoods with significant black, immigrant, or minority populations were overwhelmingly graded as hazardous, that red category, regardless of the actual condition of the housing or the creditworthiness of the residents. This practice became known as redlining, and its effects were devastating. The FHA adopted these maps as guides for its own lending decisions, refusing to insure mortgages in redlined neighborhoods. The VA followed suit with GI Bill loans. Private lenders, taking their cue from the federal agencies, similarly refused to lend in these areas. The result was a systematic exclusion of black Americans from the greatest wealth-building program in American history. The statistics are damning. In 1947, only 2 of the more than 3,200 VA guaranteed home loans across 13 Mississippi cities went to black borrowers. In the New York and northern New Jersey suburbs, fewer than 100 of 67,000 mortgages insured by the GI Bill supported home purchases by non-white families. Developers like William Levitt explicitly refused to sell homes in Levittown to black families. The suburban dream was deliberately constructed as a white dream, and the financial institutions of the federal government were complicit in building and enforcing that wall. This is one of the most consequential injustices in American economic history, and its effects persist to this day. The racial wealth gap in the United States, which sees the median white family holding roughly 10 times the wealth of the median black family, can trace its roots directly to these housing policies. When white families were building equity in homes that appreciated over decades, black families were locked out of ownership entirely, confined to red-lined neighborhoods where property values stagnated or declined, where banks refused to lend, and where the path to generational wealth was systematically blocked. Now let's step back and consider what all of this means in the broader sweep of history. The 30-year fixed-rate mortgage is often treated as a simple financial product, a routine piece of paperwork you sign when you buy a house. But in reality, it is one of the most radical economic inventions of the 20th century. It transformed the United States from a nation where homeownership was a luxury into a nation where homeownership became the primary vehicle for middle-class wealth accumulation. It fueled the suburban explosion that reshaped American cities, highways, schools, retail, and culture. It created an entire ecosystem of financial institutions, from Fannie Mae and Freddie Mac to the modern mortgage-backed securities market that channels trillions of dollars into housing. And it's worth noting that this system is distinctly, almost uniquely American. In most other countries, mortgages look a lot more like the pre-Depression American model. In Canada, the most common mortgage term is 5 years, and loans rarely extend beyond 10. In the United Kingdom, fixed-rate periods of 2 to 5 years are standard, after which the rate becomes variable. In many European and Asian countries, adjustable-rate mortgages with shorter terms dominate. The fully amortizing 30-year fixed-rate mortgage is a peculiarity of the United States, a product of a specific historical catastrophe and the government's response to it. Without the Depression, without the New Deal, without the FHA and Fannie Mae and the GI Bill, American housing finance would likely look a lot more like the rest of the world's, and yet the system we built isn't without its own dangers. The very features that make the 30-year mortgage so attractive to borrowers, the low monthly payments, the long time horizon, the government backing, also create enormous risks when they're pushed too far. We saw this in 2008 when the housing market collapsed again, eerily echoing the catastrophe of the 1930s. Lending standards had been loosened to the point of absurdity. Mortgages were being given to borrowers who had no realistic ability to repay them. These toxic loans were packaged into complex securities and sold to investors worldwide. And when the borrowers inevitably defaulted, the entire global financial system nearly came crashing down. Fannie Mae and Freddie Mac, the very institutions created to stabilize the mortgage market, had to be seized by the federal government in September of 2008 to prevent their total collapse. The cost to taxpayers ran into the hundreds of billions. It was a painful reminder that the system built in the 1930s, for all its transformative power, is not self-correcting. It requires constant vigilance, responsible regulation, and recognition that housing is not just a financial asset. It's where people live, it's where they raise families, it's the foundation of communities, and the single largest investment most Americans will ever make. So, the next time you sign a mortgage document, the next time you make a monthly payment to your bank, take a moment to consider the sheer improbability of what you're doing. You're participating in a financial system that was invented less than 100 years ago, born from the wreckage of the worst economic disaster in American history, designed by government officials who were desperately trying to prevent the total collapse of home ownership in the United States. Before them, buying a home meant either being wealthy enough to pay cash, brave enough to gamble on a balloon mortgage, or lucky enough to have a building and loan in your neighborhood. The idea that a regular person could walk into a bank, borrow money for 30 years at a fixed rate, and slowly, steadily pay it off while living in the home, that idea simply did not exist. It had to be invented. And the fact that it works, that it has worked for tens of millions of families over nearly a century, is one of the most remarkable achievements in the history of American economic policy. policy. But it's also a system that was built with deep flaws. Flaws that excluded millions of people based on the color of their skin. Flaws that can be exploited by reckless lending and insufficient oversight. Flaws that remind us that even the most transformative institutions require constant improvement to serve the people they were designed to protect. The 30-year mortgage is not a natural law, it's a human invention. And like all human inventions, it reflects both the brilliance and the failures of its creators. Understanding where it came from helps us understand where we are, and more importantly, where we might need to go next. If you found this story as fascinating as I do, please consider subscribing to the channel. It really does make a difference, and I genuinely appreciate every single one of you who takes the time to do that. Also, if you haven't already, make sure you check out this video right here. I think you'll love it. Thanks so much for watching.